In the year 1719, a man named John Law pulled off the greatest magic trick in the history of finance. He convinced the entire nation of France to stop using gold and start using paper. But it wasn't just any paper, it was shares in the Mississippi Company. Law told the public that the French territories in Louisiana were overflowing with gold and emeralds. Desperate to escape their national debt, the French people bought it. Within 2 years, the share price went from $500 livres to $18,000. People were selling their ancestral estates, their jewelry, and their livelihoods just to buy more paper wealth. They were literally trampling each other in the streets of Paris to get into the bank. But here's the kicker. Louisiana was a mosquito-infested swamp. There was no gold. There was no profit. Law was just printing money to buy his own stock, a classic feedback loop. When people finally asked to see the gold, the bank was empty. The shares crashed to zero, the economy collapsed, and France was financially scarred for a century. I'm telling you this because the exact same pattern is repeating in 2026, except this time the swamp is your index fund and the powdered wig is your brokerage app. Most people think they are safe because they own an S&P 500 index fund. It's 500 companies, Calvin. I'm diversified. Is that true? Imagine you're building a dream house. Your contractor says he's using the most diverse materials on the planet. But then you look at the blueprint and realize that 70% of the entire structure, the foundation, the roof, the walls, is supported by only 7 wooden beams. Sure, those are the 7 strongest beams in the lumber yard today, but if just 3 of them get termites or a single one cracks, the whole house falls. In early 2026, those 7 beams are Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, and Tesla. These 7 companies, just 1.4% of the index, now represent over 30% of the entire value of the S&P 500. Back in the 90s, the top 7 companies made up about 15%. We've doubled the concentration in 25 years, and the industry is telling you it's normal. It isn't. It's a concentrated bet on 7 tech companies staying perfect forever. Now you might be thinking, but Calvin, these companies actually make money. They aren't Law's Louisiana swamp. You're right. They are incredible businesses. But so were the Nifty 50 in 1972. The Nifty 50 were the blue chips of the early 70s. Companies like Polaroid, Xerox, Kodak, Avon, and Sears. Every expert on Wall Street said these were one-decision stocks. The only decision was to buy them. You'd never have to sell. They were the backbone of America. Investors drove their prices to $50, $60, even $80 times their earnings. People said valuation didn't matter because their growth was inevitable. Then 1973 hit, inflation spiked, an oil crisis arrived. Suddenly, growth slowed. Polaroid plummeted 91%, Avon dropped 86%, Xerox fell 71%. If you bought at the peak in 1972, it took you 25 years just to break even on an inflation-adjusted basis. Think about that. A quarter century of zero returns while the world moved on. Why does nobody talk about this? Because the financial industry is designed to hide risk from you. They use a trick called market cap weighting. In a market cap weighted index, the more a stock goes up, the more of it you are forced to buy. When Nvidia's price doubles, your index fund automatically funnels more of your next paycheck into Nvidia at the higher price. It is the literal opposite of buy low, sell high. It is buy what is already expensive. The bankers love this because index funds are easy to scale and generate massive fees. When they tell you just buy and hold, what they really mean is don't ask questions for 30 years while we collect our percentage regardless of whether you're winning or losing. I'm not here to just scare you. I'm here to show you how I'm playing this. If I were starting a portfolio from scratch today, knowing what I know about this concentration risk, here is my 5-step manual. Step 1. The reality check. Log into your brokerage. Don't look at the balance. Look at the top 10 holdings. If those 10 companies make up more than 25% of your total wealth, you aren't an investor. You're a tech speculator. Step 2. Inverse concentration. Instead of letting the market force you into the most expensive stocks, I'd also look at international developed markets and small cap value. These sectors have been ignored for a decade, which means they are on sale while the big 7 are at retail. Step 3. Valuation tripwires. Remove the emotion. Use what I call the 8% rule. If any single stock in your portfolio grows to become more than 8% of your total account, you sell enough to bring it back to 8%. You prune the garden. This forces you to harvest gains when things get crazy and prevents one company from having the power to ruin your retirement. Step 4. Build an income floor. The reason people lose money in crashes isn't the crash itself, it's the panic. If you have 12 months of expenses in a high-yield savings account earning 4 to 5%, you don't care if the market drops 30%. You don't have to sell at the bottom to pay your mortgage. You can wait. Step 5. The time horizon reframe. If you are 25, ignore this video. You have 40 years to wait out a bubble. But if you are 45 or 55, you do not have 25 years to break even like the nifty 50 investors. The sequence of returns matters more than the average return. A crash in 2026 could permanently lower your standard of living if you don't de-risk now. Let's look at one final chart. In 1989, Japan was the king of the world. The Nikkei index hit 38,915. Japanese companies were buying up the Rockefeller Center and Pebble Beach. Everyone said the US was finished and Japan was the future. Stocks in Japan traded at 60 times earnings. If you bought the Japanese index in 1989 and held forever, you lost 75% of your money in 3 years. It stayed down for decades. Only recently, in the mid-2000s, did it finally touch that 1989 peak again? 37 years to get your money back. The market always comes back is a dangerous half-truth. The global market comes back, but specific sectors and specific countries can stay underwater longer than you can stay solvent. Wealth isn't built by hitting home runs. It's built by not striking out. The people who got rich and stayed rich are the ones who didn't blow up when the music stopped. Don't follow the crowd off the cliff. Stay grounded, stay diversified, and I'll see you in the next video.